Hello, everyone. It is Thursday, December 8th. Been a little bit since I've updated some of the more important charts that we've been following in 2022. So want to take just a couple minutes to update you on what those look like. Let's jump into it. So this first chart is another look at the dollar. We've been following this and sharing this all year. This has been the main driver. If the dollar is strengthening, stocks are going down. So as you can see here in the last couple of months, call it since late September, the dollar has fallen about 8.7%. If you can see that from its high to its bottom, and obviously stocks have rebounded a little bit. Just as a reminder why that is the case, again, if there's a strong dollar, that's good for us here in the United States. If we want to do things outside of the United States, our dollar is going to go further. But why it's negative for stocks is that if most of our companies are big companies, are global companies, right? And if people or governments from other countries want to buy our goods or services, their currencies, they're having to spend a lot more of their own currencies to get these goods and services in dollars. So if they spend less on our companies because their money's not going as far, then the corporate revenue and therefore the corporate profits of our companies are going to come down with it. So seeing the dollar come back down a little bit is going to always be a pretty good sign for U.S. stocks. So it has fallen down here to the 200-day moving average, which you can see in the purple, and it's starting to kind of do a little sideways chop here. We would not, it would not surprise us to see the dollar kind of rally back, for it to go back up to 114 and beyond. What that's going to mean is in between now and that happening, if it were to happen, is we're going to get some pretty poor inflation numbers and going to lead the economy and the market to believe that the continued interest rates or even higher interest rates are going to have to come to take that inflation down. So we don't see that being the case. We think that peak inflation is behind us. Not that it's going to be over tomorrow, but the worst of it is in the past. Now, why we think in the short term we might still get a little bit of a bounce. If you pop down here to this bottom panel, this is relative strength, the momentum indicator, and you can see it's not hitting 30. When you hit 30, that's considered to be oversold status, which would mean in the short term you get a little bounce, but it means that momentum is completely waned from this asset, and you expect further decreases over the long term. Even though being oversold in the short term might cause a little bounce, the momentum is definitely negative. And because we're not getting a 30 reading, that would lead us to believe that momentum is not completely at a failure point, and we could see a decent little substantial rally here out of the dollar. So we'll definitely be monitoring that. If we do start to see a little turn, I'd expect us to pull some of our equity weighting off the table to try to avoid additional losses there. Jumping over to interest rates. This is the 10-year government yield. Okay, what you could get by investing your money with the federal government over the course of 10 years. Closed today at 3.492%. Let's call it 3.5%. This is down from its peak of 4.3%. So that's good. Okay. If interest rates are coming down, what does that mean? It means our bonds are going back up. Reminder, inverse relationship there with stocks or with interest rates and bonds. Interest rates going up, bonds come down, and vice versa. So again, interest rates peaked there middle of October. They've come down, and naturally we've seen some stock prices start to come back up. But again, as we've seen with the dollar, it's hitting the 100-day moving average and trying to put up a little bit of a fight here. This red line here showing this previous resistance here. The market came up to 3.5% and fell down, came back up, and then it's kind of acted as support. So if this would be a good spot for it to probably move sideways and decide, hey, do I want to go back up or am I really falling to the downside? Just like with the dollar on momentum down here in the bottom right, again, we're not getting that oversold status. We're not getting that change in momentum. And you can see that back here in August. Okay, same thing happened. It fell from 3.5, down to 2.5, never got oversold, and then the rally ensued. So what we have already done is, back here when rates were at 4.3, we actually extended duration. Remember, in the past, we've been going shorter term bonds because if interest rates are going down, interest rates going up, bonds are coming down. The longer term your bonds are, okay, they're going to fluctuate up and down more. So when we got to that 4.3 range, we actually bought long-term treasuries, hoping for the interest rates to continue to fall and that our value of our bonds would go up, and that they were longer-term bonds, they would go up more. We played that pretty decently. We've actually took that off the table because of what we're seeing here, okay? We're seeing this 3.5% be an area where the market's going to probably chop around to decide where it wants to go. And also, we're not getting that oversold status like we never got in August. So we do expect potentially for a little bit of a rebound in the shorter term on 10-year treasury. But again, we feel like the peak interest rate hopefully is in place at 4.3, and things would have to really start coming in bad again for the market to push this rate even higher. We do have some big important inflation data and the Fed speaking over the next 2 weeks. So that could sway this in a certain direction. So ultimately, what does all this mean for the stock market? Here's a quick look at the S&P 500. Okay, so you look down here, let's go back to June, okay, where we initially bottom and rally. Okay, you can see the market comes down here in June and rallies pretty hard. Again, momentum never got oversold here. Okay, never got oversold, and the rally came. It went straight up to the 200-day moving average. You can see, I can zoom in there. I mean, it came right at it and immediately turned around. That 200-day moving average is always seen as a long-term barometer of the stock market. A lot of people simply say, if we're below it, bear market. If we're above it, bull market, right? I think it's a lot more complicated than that, but that is, an often long-term indicator of where the market may be headed next. So back in August at the peak, we hit that 200-day, immediately rolled over, okay? Now you can see this time we did get oversold, okay? Which, as I said, it would indicate maybe a shorter term bounce, but longer term fading momentum still. So here we are, we've rallied back to the 200-day moving average. We even popped over it here for a day, day and a half, and now we've fallen back down. But now if I zoom in even more, now we're starting to see the 100-day moving average act as support. Okay, so we hit this, it was resistance back here early November, and then it acted as support on November 17th, and then also November 28th and 29th and 30th, and then again here these last 3 days. It's come down to the 100-day moving average. As a reminder, this is the average closing price of the S&P 500 over the last 100 days. Okay, just seen as good longer-term barometers, and so that is acting as support. So the interesting thing here is we're getting support out of the 100-day, resistance out of the 200-day, and again, momentum is not getting overbought, okay? The opposite of oversold is being overbought, meaning short term, the rally happened, maybe expect a shorter term to the downside, but longer term momentum has completely shifted to being more positive now, and the longer term indication will be that it would climb higher. We are not getting that oversold reading here the last couple of weeks, which is what we would want to see. So we got to pay attention to this one closely. Falling below the 100-day moving average here will probably be an area where we might pull some off the table, but we'd love to see a little 100-day support here, break through that 200-day with affirmation. Okay, maybe get some good news out of inflation, right? And some more dovish talk out of the Fed could really drive things here for a year-end rally. Okay, Santa Claus rally, right? That's coming up. That's always the last 5 days of December and the first 3 days of January. It does have an incredible track record of being a really strong time to be in the market. I think optimism and excitement, and maybe people take some time off and are ready to get back into it. Lots of different factors there, but the numbers don't lie. It is a good time to be investing. So possibly seeing a little bit of chop here through through December. And if we can get some good news on some economic fronts, maybe we can get that Santa Claus rally, bust through this 200-day, and we're off and running. So a lot to be coming. I want to update you. Those are the three main charts that we've been talking about for quite a while now. We will continue to update you on that. Clients, be on the lookout for an end-of-year email, kind of a little checklist thing of things to be looking at and things to do from a financial planning perspective as we close out the year. As always, hope you guys have a great month, great December. Merry Christmas to everyone. Happy holidays, and we'll see you all very soon. Take care.